Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Mo Daoud, and today's special guest, well, he's a returning guest, John Rubino, who is the editor of dollarcollapse.com. He also recently co-authored a book with gold money James Turk called The Money Bubble. John, thank you for joining us once again.
Hey, Mo. Good to talk to you again. And congratulations on the new website. Very slick. It looks good.
Oh, thank you. Thank you. I appreciate it. We got positive feedback from all of our listeners and our friends and our inner circle, so we're very happy about it, and hopefully it will help us take us to the next level.
Good.
And congratulations to you on the book, The Money Bubble. It had positive reviews and feedback so far from what I'm seeing on Amazon and et cetera.
It just got its 100th review the other day, and it's mostly 5 stars, a few 4 stars, and so it's a 4.5-star book on Amazon, which is nice. You know, it's good to see that kind of the recognition.
Yeah, you gave me an advanced copy when it came out, and I highly recommend it to anybody out there that haven't read it yet to go check it out on Amazon.com, or you can go to his website at dollarcollapse.com.
Excellent.
So, John, I want to start off the podcast and talk about a recent event that happened. Recently, the G7 agreed to allow the Chinese Yuan to join a basket of currencies, which is known as the SDR, the Special Drawing Rights. What are your thoughts on that?
Well, I think it's inevitable that China, its currency and its government become major players in the world. It's the second biggest economy, and they're becoming a military power. So they're going to be one of the leaders, for better or worse, in every aspect of the global economy and global politics in the decades ahead. And, there's nothing surprising about a country that's 1/4 of the world's population, and now with the second biggest GDP, being a leader like that. So we should have expected it to happen, and we shouldn't be surprised. And we should hope that China evolves into a good global citizen, which we'll see. And as for the yuan being part of the special drawing rights at the IMF, that's kind of a no-brainer. It's the second biggest trading country in the world, and their currency should be a major trading currency, and it should be at least a minor reserve currency. In other words, people should be willing to hold yuan as a relatively risk-free asset, as a currency that they expect to hold its value over time. That's China's challenge, to maintain the value of the yuan going forward, so that it evolves into a reserve currency. And I don't know that their goal is to challenge the dollar, but logically, that's what's going to happen over time, because the Chinese economy is growing faster than the U.S. economy. China's population is growing faster than America's population, and there's no reason to believe that those trends are going to reverse anytime soon, because they've just got, they're still a developing country. They've got further to go. So they're going to get very big in the next couple of decades, barring some kind of global financial crisis that stops technological as well as economic progress. We've obviously got a big financial crisis coming. That's the point of the work that you and I do. But I doubt if that changes the relative trends between the U.S. and China. China's just going to get bigger, and that's all there is to it. And so the SDR thing is one of those things where it's hard to know what to think of it, because that seems to be, in the minds of a lot of people, the next global reserve currency that we'll move to if we screw up the dollar, which we are, and if the euro turns out to be less than viable, which it is turning out to be, then we're going to need a better reserve currency. And a lot of people think that SDRs will be that, the new currency that everybody uses as their risk-free savings around the world. But all SDRs are, they're just a basket of these fiat currencies. And these fiat currencies are being horrendously mismanaged. So the idea that a basket of horrendously mismanaged currencies can somehow turn into, in its own right, a viable currency, I don't get. The SDR strikes me as kind of an asset-backed bond made up of subprime mortgages from the middle of the last decade, something that they used to create in 2005 or 2006, and then sell to gullible investors with the promise that because there's a whole bunch of mortgages in the package, that it's diversified and nothing will go wrong. Well, if you package up a bunch of crappy assets, the thing you package those assets into is by extension crappy. And I think that's what the SDR is. So it's not going to be a currency that has legs, that lasts a really long time. It could be a stopgap on our way to something a lot more stable, like a gold-backed currency again. And so it could be something that we pull out when the dollar has its final big crisis, or when the euro starts to spin apart, or the yuan turns out not to be the stable currency that it looks like it has a chance to be now. When one of those things happens, and we go to SDRs, it won't last long, because we'll figure out pretty quickly that it's just made up of dollars and euros and yen and yuan, and so it's no better in the aggregate than these other currencies are, and these other currencies aren't well managed. So I think that at best it delays the inevitable, and that we have a major, serious currency crisis which leads to a reset of the global financial system in the not too distant future.
I consider this move also more, rather, instead of just an economic move by the Chinese, also a political move by Chinese, because there seems to be a lot of war of words between the Chinese politicians and also the U.S. politicians. A lot of going back and forth on the military, and also the way they, accuse of the Chinese of manipulating their currencies, which is hypocritical because the U.S. government also are manipulating their own currencies. So I consider this more also of a political move by Chinese. I don't think they're trying to piss off the U.S. Government, but I think they're just trying to advance their own currencies and maybe perhaps become a part of the world reserve currency in the future.
Well, yeah, and on the political side of things, China and Russia and several other countries who are, would-be superpowers, at least in their own neighborhoods, really chafe at the U.S. dominance of the world militarily, and a big part of the reason that we can finance a military budget that dwarfs the next 10 military budgets put together around the world is that we have the world's reserve currency, which gives us basically an unlimited credit card. We can, in effect, borrow our military budget on the global markets, a lot of that from China, and then we use the super powerful military that we build with all this borrowed money to bully the rest of the world. Well, the rest of the world doesn't like that, and Russia and China in particular would like to have their own spheres of influence free of U.S. dominance, and that's what we're bumping up against with China right now, and with Russia in the Ukraine. Is these rising powers wanting to assert themselves in their own neighborhoods. And again, that's a completely natural thing. We in the U.S., we have 5% of the world's population. Were we going to continue to dominate the world forever with 5% of the population? Of course not. We can never afford something like that in the long run. We would go the way of the Roman Empire and all the subsequent empires that got overextended and went broke. And that's really what we're doing. We think we should be able to continue to boss everybody around. And the fact that we're borrowing absolutely insane amounts of money year after year after year and building up this huge mountain of debt, which eventually, if history is any guide, is going to come back to burn us and to take away the ability to exert power around the world. It's going to happen eventually, that we have to give in and let some of these regional powers have their say in their own neighborhoods, and China looks like it's the one that is coming to a head right now. We're bumping up against them in the South China Sea, where Japan and China are disputing over some islands, and China's not backing down. So the U.S. has military assets in the region. We don't have nearly as many as China does, but there's probably no doubt that in a straight-up fight, the U.S. would still win against China right now, but that would be horrendous. The global financial system is fragile as it is because of all the debt we've taken on, and let a shooting war start between the two most powerful countries in the world, and we would see a financial crisis that would come out of nowhere and decimate most of the global financial markets because, and rightfully so, everybody would be terrified of something like that spinning out of control. And so we're really playing with fire over there, where we send ships to harass Chinese ships, and they threaten to do various things to our ships. This is the kind of thing that we shouldn't be doing, and it isn't clear what the solution is, because when there's one piece of land that several different countries all claim, you've got a potential conflict there. So I don't have a solution for it, except to say that it's not in anybody's interest to escalate this thing to the point that it causes a global financial crisis, because we're talking tens of trillions of dollars just vaporizing if the U.S. and China start shooting at each other. It's almost inconceivable with asset prices where they are right now.
One of the requirements that China has to do in order to join the SDR is to disclose the amount of gold that they have in the vault. So what impact do you think that will have in the gold market? Because there's a lot of rumor and speculation out there that China might have 20 to 25,000 tons of gold. And in the past few years, they've been accumulating the equivalent of the annual mining supply of gold. So what impact do you think it will have on the gold market?
Yeah, China's been accumulating a lot of gold in the last few years, and there's a debate about why they want it. Are they just buying an asset that they think is undervalued and will go up, or are they intending to back their currency with gold and have the only gold-backed currency in the world, or are they just trying to gain legitimacy in order to join the club? Do they want to have a rock-solid currency comparable to the dollar and the euro and the yen, so that they get all the privileges of having a hard currency, which is to say they get to join all the big international clubs and have a say in how the global institutions rule the world. And so they've accumulated a lot of gold. They'll announce something when their currency joins the SDR, and what impact it has on the gold market probably depends on the number that they announce. And remember that China doesn't feel any obligation to tell the truth about any of this stuff. They announce gold reserve increases every 5 years, and they don't announce anything in between. So in effect, if they continue to report, the old official gold reserve number, they're lying to the rest of the world about it, and then they revalue, or they announce that they have more gold than they said they did. And so they're going to do that again. They're going to say they have more gold than their official reserves indicate right now, but they may not admit to all the gold they've accumulated. And so there's no way to know what number they're going to throw out there. And there's no way to know what they have, actually. And a lot of estimates seem to coalesce around 3,000 tons, which would put them in Germany's category, which is pretty good. That would be enough to give the yuan legitimacy. But I don't think that would send gold's price to the moon. However, if they came out with some much higher number, that would cause the marketplace to reevaluate gold and probably cause a lot of buying pressure and probably send gold's price up. But I don't think we can count on that, because China's going to do what is in China's best interest. And if they intend to accumulate more gold in the future, then it's not in their interest to do something that would spike the price of gold right now. However, if they've accumulated all they want and they'd like to see it go up in value, then maybe it is in their interest to announce some really high number, to completely tell the truth about what they've accumulated, and see if it doubles the value of the stuff they bought in the last few years. So there's no way to know. And all the speculation about it won't shed any light until they actually make some kind of an announcement. And even then, we're only hearing what they want to tell us. So I don't know. I think that the fact that they continue to buy gold, and that the numbers coming from the Shanghai Gold Exchange about the amount that is imported into China and the numbers that are announced about China's indigenous gold miners and how much they produce. I think those are legitimate numbers. And that comes to a couple thousand tons a year. That China is accumulating right now, but we don't know whether it's the government or private individuals. There's so much we don't know about this, but we know the numbers are pretty big. So I think it's almost, however you slice it, a positive for gold because this big, powerful country is accumulating so much of it. But we can't say in advance whether it's going to be extremely positive or mildly positive, or whether China announces a number that's low enough to actually cause gold to go down. We can't know any of that. But we can know that they're buying a lot of it. And so that in the long run, that's a vote of confidence for gold as a monetary asset in the intermediate term future. And I think that's good enough, that powerful, very, very long time frame country like China is aggressively buying gold in and of itself is a good thing.
Now, I was asking this question because there's a lot of gold investors out there that think that once they disclose the amount of gold they have in the vault, that this is going to be the catalyst that's going to send the price of gold to the moon, because I think a lot of gold investors are getting tired of the sideways action in the past few years in the gold and silver market. So they're just looking for anything that they think that might help the gold market take off again.
Well, I'm definitely tired of this sideways action too. Gold has been basically backing and filling and building a base for 2 years now. And I think it's long enough. I think we've shifted from weak hands to strong hands in this time, and that there's at least a good chance that the bull market resumes sometime in the not too distant future. There can always be a deflationary scare where, for instance, Europe spins out of control. The Eurozone starts to break up, or the major economies like the U.S. and Germany and Japan continue the slowdown that the U.S. has begun lately. Let us drop back into negative growth, into recession and deflation, and it's not clear how we get out of it at this point, because we've spent the last, especially in the U.S., but also and especially in China or Japan also, but also in Europe now, we've been doing QE. We've been pumping huge amounts of newly created currency into the banking system for years. And you would think that with zero interest rates and trillions of new dollars being created the way the world's central banks have done in the last few years, that we would be in a raging boom right now. But instead, that money is just not being spent. The velocity of money, which is a measure of how many times a given newly created dollar turns over in the economy, is plunging. It's down to Depression-era levels now, which means that banks don't want to lend. People aren't really borrowing the way you would think they would with zero interest rates, and people just aren't spending as much money as you would think with so much easy access to new credit. So this is kind of uncharted territory, and it's something that Keynesian economics, which is the dominant version of macroeconomics out there among policymakers right now, says shouldn't happen. You lower interest rates to zero and you get a boom. That's what Keynesian economics basically says, and that's been historically true. I mean, every time we've lowered interest rates dramatically in the past, we've ignited a new asset bubble. We did the junk bond bubble, and then the tech stock bubble, and then the housing bubble, and now we've got a global bubble in government bonds, but we don't have any growth on Main Street. The average person, especially in the U.S. but also in Europe, does not feel like they're in any kind of a boom. They don't feel like their finances are improving or that their future is any brighter than it was 2 years ago. And that's because all of this money has just flowed to the rich people of the world. They're buying expensive assets. Art is at all-time records, and London penthouses and Manhattan condos and Miami condos. All those things are booming. But the stuff that the average person looks at in order to decide whether the economy is growing or not, that's not really improving. And this is new. In past economic expansions, it's been a lot more broad-based. People have gotten better and better jobs, and wages have started to go up. And then we've had wage pressures, and that's what's led the Federal Reserve to tighten. And this time around, there's very little wage pressure. Even though everybody has a 2% inflation target, all the central banks, they can't meet it. Nobody can generate even 2% inflation with zero interest rates and massive money creation. Japan is creating, in terms of its own economy, the equivalent of several $1 trillion a year of new currency, and it's not working. And Europe is aggressively buying bonds now. The central bank is, and that's not really working. And they've both those two countries have pushed their currencies down dramatically against the dollar, and have seen only a minuscule improvement after a major currency devaluation. So now it's the U.S. turn. We are going to have to cut the value of the dollar going forward if the most recent economic numbers are any indication of what's happening here, because we're starting to slip back into recession. The first quarter GDP now was just revised down to negative 0.7% annual rate. Second quarter GDP, most economists think it's going to be up marginally, but then factory orders just came out today, having dropped for the 8th time in the last 9 months. So and consumer spending was down just lately. So can you have a growing economy when factory output is shrinking and consumers are spending no more this month than last month? And the answer is no, you can't. So we are dropping down into a danger zone, which normally leads to aggressive currency devaluation. When your economy starts slowing down and starts dropping into recession, one of the things you do is you make your currency less valuable. So that you can sell more stuff overseas. American stuff, when it's sold overseas, is priced in dollars to begin with. So if the dollar goes down in value, that's like us throwing a 20% off sale, and we'll sell more stuff. That's what happened to Europe and Japan in the last few years, and that helped them. Their export industries are among the lone bright spots in those two systems. So we need that again here. But it's not clear what we do, because interest rates are already at zero. We've already created trillions of new dollars of cash thrown into the banking system. So what do we do next if that didn't work? And so that's where you get the really interesting part of the story, because they're going to do crazy things. And they will give us a lot of stuff to talk about for the next couple of years, Mo, because they're going to do things that we would have thought would be impossible in normal times. But these desperate, panicked governments are going to do some really amazing, really experimental, really scary things, beginning with an attempt to ban cash. You're seeing that around the world. The war on cash is now a headline, even in the mainstream press. And that is, first of all, something that most economists would have said would never happen. If you asked them 10 years ago, they'd say, governments can't ban cash, come on. And now we've got governments trying to do it. So that, among many other things, will be tried in the next few years. And, I'll go out on a limb right now and predict none of it will work because the system is irreparably broken. At some point we will figure out that nothing's going to work, and then everything changes. But until that time, we'll give the governments the benefit of the doubt and let them try their new things and watch them fail.
I was looking at the chart for the Japanese yen, and it just recently broke the $122 resistance level with no end at sight until around $144. Well, so the deflation scale is going to continue on, and I just want to get your thoughts on that. Do you think that'll be a bad thing for the economy that's built on a premises that inflation is essential for economic growth?
Do I think plunging yen is a bad thing?
No, do you think deflation is a bad thing?
Oh, yeah, deflation is a horrible thing. Well, deflation is actually the normal state of a healthy economy, okay? Because as you get more productive, you make things more efficiently, and they get a little cheaper, right? So prices should go down a little bit year after year. But
people start saving, too.
Yeah, and your savings get more valuable. That's a healthy environment. So your savings get more valuable, and the stuff you would buy with your savings get cheaper, so you get richer. But in an over-indebted society, when you borrow too much money, deflation is death because it makes your debts harder to manage. And you can't handle that if your debts are already extremely hard to manage, which is the case for everybody in the world. There is no major country that isn't grossly over indebted right now. And so they need inflation because that makes your debts easier to manage because you're paying off your future debts with cheaper currency. But in deflation, it's the opposite. You're paying off your future debts with more expensive, more valuable currency. And it's harder. And fewer people can do it. People start defaulting, and then you spiral down into a 1930 style depression. That's what the world is staring at right now. And so they can't let it happen. So they have to find a way to lower the value of their currencies. They have to do a global devaluation at some point, or suffer a 1930 style deflationary depression. Those are our only two choices. And so they're thrashing around trying to figure out how to do this. You know, they've already lowered interest rates to zero. They've already run the printing presses flat out and bought back most of the high grade debt that exists out there. You know, and now they're buying back stocks. You know, governments are in the stock market buying equities, and none of it has saved us. None of it has worked. It's pushed the stock market up. It made bonds go up in price and down in yield, but it didn't get the economy growing again. You know, there aren't new jobs being created that are any good. You know, in the U.S., we've got a lot of jobs being created that are part-time jobs. You know, you can go work at McDonald's if you want to, but you can't get that engineering or corporate finance job that you used to have back. And to the government and government statistics, that's basically a wash to them. You know, you lose your $250,000 a year engineering executive job and then go work at McDonald's. Well, the government says, well, there's the same number of jobs in the economy. So unemployment didn't change. Well, your life changed, though. You know, now you're working at McDonald's when you used to be an executive. And that's happening across the spectrum in the U.S. right now, where good jobs are being lost and they're being replaced with crappy jobs. And so the government knows this. You know, they don't say it out loud, but they know it. They see it happening. And they know that the tax base is shrinking because people working at McDonald's don't pay nearly the kind of taxes that engineers and scientists and executives and corporate lawyers and other highly paid people normally pay. And so the next round of desperate measures, and they will be desperate measures, will center around getting interest rates even lower than they are now. In other words, pushing interest rates below zero. And in economics, there's this concept called the zero bound, which says that interest rates can't go for long periods of time below zero because everybody will just take their cash out of the bank. You know, if the bank is charging you negative interest, in other words, or paying you negative interest, in other words, charging you for the privilege of having a bank account, then there's no reason to have a bank account. You take your money out, you put it in a safe deposit box or a vault or bury it in the backyard or whatever, but at least it's not costing you anything to do that. So as interest rates get more and more negative, there's more and more of an incentive to pull money out of the banking system. But if everybody pulls money out of the banking system, it implodes. And so the governments of the world are looking at ways to be able to lower interest rates without allowing people to suck all the cash out of the financial system. And one thing they're trying to do is to make cash so inconvenient that everybody just dispenses with cash and goes electronic, which we are mostly anyhow. You know, most of our money is in bank accounts that we transact with via plastic of one kind or another, or with our cell phones. You know, we don't carry around huge wads of cash anymore. So in the minds of the guys running the governments of the world now, the next step is just to get rid of cash altogether. And that would prevent us from obviously pulling our cash out of the bank because we wouldn't have cash anymore. And it would give the governments the ability to push interest rates down even further because we'd have nowhere to go. We would be stuck with that bank account yielding negative 2% and the money market fund yielding negative 1.8%. We wouldn't be able to go anywhere else. We'd have to live with that kind of an environment. So basically, they would penalize savers big time and push everybody out on the risk spectrum in order to try these economic experiments to see if zero interest rates didn't work, maybe negative 2% rates will work to get the economy moving again. But the casualties of that kind of a policy are many and mostly undeserving. The people who are being hurt by this are savers and retirees and the pension funds that supposedly protect the futures of savers and retirees. They're being forced to take bigger and bigger risks because the old bonds and cash that they used to hold doesn't pay anything anymore. And so now they've got to buy growth stocks and junk bonds and foreign equities and things that used to be part of the really aggressive section of their portfolio. And now it's becoming the whole thing because that's the only part of an investment portfolio that generates any actual returns anymore, because cash doesn't and bonds hardly do. And so if you're a pension fund and you need 8% to satisfy the requirements of the people who are going to retire someday and who are going to depend on you, you don't have any choice but to take really aggressive risks with your money. If you're a saver who needs to get to a certain point in order to be able to retire, say you need $400,000 in the bank because that's what your financial advisor told you was your bogey. Well, you've got to take some big risks to get there now because you will never get there if you put money in the bank and it charges you 2% a year. You go backwards with your capital in that scenario. And so it's pushing all these people who don't really necessarily understand extreme risk into extremely risky things just in time for the next bear market to hit, because all these things are priced for perfection. Let anything happen that's surprising to the markets in any way, and we'll get a 10% correction that could easily turn into a 20 or 30% bear market, just like we got at the end of previous bubbles. There's nothing mystical, magical, or surprising about a 30% drop in the stock market. It happens every decade, if not more often. And we're at the point temporally and in terms of valuation where it could happen again very easily. And so all these people who really should be the object of, the government should be taking care of them. Government policy should be skewed to help savers and to make it easier to build up capital and to retire someday. And instead, governments are actively screwing these people over. So we're creating conditions in which a lot of people who think they have X amount of money are going to find out that they actually have X minus 30%. And they're going to be really mad. It'll be interesting to see politically what happens when all these people who didn't used to even be stock market investors or junk bond investors and who have become that in the last few years because of government policy and then lose a lot of money. We'll see if they put the pieces together and figure out that it was the government who did that, and we'll see what they do with their votes at that point. So, it'd be nice to see a Ron Paul libertarian benefit from this, but I wouldn't be holding my breath.
Yeah, it looked like we're in a no-win situation. If we have deflation, everybody will default on their debt, and then we'll go back into another Great Depression. But yet, if we have inflation, they're going to continue to print money, but the only problem is that other countries printing money as well. So there's a currency war going on. Everybody's trying to create inflation, so it's hard to grow inflation. And so that's going to punish the middle class and the savers, because now their currency is devaluating. But at the end of the day, they're going to have to default on their debt anyway, because they have so much of it and not enough to pay it off.
Yes. Well,
it seems like deflation is going to happen regardless.
Yeah, I mean, it depends on the form of the default. They can't pay this debt, so they won't. But how will they get out of it? Will they make their currency worth half as much and pay off their debt, but in currency that's only worth half as much? So in effect, they defaulted on half their obligations. Or will they just default? Just say, I'm sorry, I can't pay you. I just can't do it. And then stiff everybody who lent money to, for instance, Italy. Italy can't pay their debts. Who are we kidding? Spain, Portugal, obviously Greece, and Japan and U.S. None of us can pay our debts. So as you said, it's kind of a no-win situation for most people because there's nothing on the spectrum of traditional investing options that is safe from this process. You could put a lot of cash away and think that you're in risk-free assets, but then they devalue the dollar by 50%, and the value of your cash goes down by half. Or you get into blue chip equities, thinking these great companies are going to be fine. They can always find a way to make money, especially if the currency is going down in value. And then we have a deflationary crash when all equities go way down, and you lose 60% of your money. There's no real way to guarantee that you're going to come through this without major losses. And that's true of hedge funds. That's true of all the players in the leveraged speculating community, because nobody really can predict how this plays out with any degree of certainty, because we're talking about the decisions of individuals under pressure running the governments of the world. And they're operating with broken models. First of all, they have these formulas that tell them if they do one thing, something else will happen. Well, those don't work anymore. So they can't know what's going to happen when they do X, whether it'll be Y or Z or some other letter that's not even on the spectrum of what they consider possible. They just don't know what's going to happen. And because of that, there's no way to know what they're going to choose, especially when things start spinning out of control. So this is an incredibly uncertain time. It's a very hard time to manage money, and a very hard time to preserve capital. Now, historically, obviously, precious metals have done that. The more uncertain things get, the less we trust governments, the more relatively valuable precious metals get, because those are things that governments can't just create more of on a printing press. However, governments have actually banned gold in the past, and if the war on cash succeeds, then that's liable to drive a lot of money into precious metals. We'll create an underground economy that uses other forms of money like gold and silver to transact. Well, then the government's going to come after them too. And who knows how that plays out, because the government actually did ban gold in the U.S. for 40 years after the Great Depression, and only made gold legal to own for individual Americans again in the 1970s. Well, would we do something like that again? I don't know. And would technology allow us to get around that with things like Bitcoin and the new BitGold service that just bought gold money and other kinds of payment systems that aren't tied to one nationality's or one nation's banking system? So, there are an awful lot of moving parts here, Mo, and I wouldn't even pretend to have a general idea of how this works out in its specifics. But it does seem like it's going to be very chaotic and very uncertain and very unpredictable for a few years or longer. There's no way to know if this resolves with a short, sharp break or some kind of grinding thing that goes on for years and years.
Yeah, it'll be interesting for the next few years to see what happens. Well, John, thank you for joining me again for a podcast. If you don't mind, can you give out your website one more time?
Sure. I run dollarcollapse.com, which covers a lot of the stuff we just talked about. And my latest book, as you mentioned before, is The Money Bubble, co-written with Gold Money's James Turk, which also covers a lot of this stuff and gets into the details of how you invest to protect yourself in these kinds of uncertain times.
Okay, great. Well, thank you, John, and hopefully we can talk again soon.
Great. Thanks, Mo.